All right. Today is Wednesday, August 3rd, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What a day it was. Yesterday, we were talking about the fears of Chinese retaliation. We were talking about the technicals looking like they're running out of gas. And what do you know? Today, we got hot, nice, warm pies all over the place. So if you ate a pie today, don't feel bad. Yours truly, the guy you're listening to right now, also ate a pie in one of my trades. But I do have a feeling that the pie factory is not done here. I believe that the next order of pies will be served to the other side, the side that bought the hype today. The traps are being laid all over the place, and there is a massive, massive problem in the market sentiment right now. Yes, it was too bearish before, and that merits a technical rebound. We all know that, but we're now getting into the delusional part once again. Market sentiment is becoming really delusional. This is one of the biggest gains in the stock market since November of 2020, and it's all done in a short amount of time. We've seen these kind of rallies before. Some call them bear market rallies. I don't care what you call them. What I care about is what is the real reason behind the rebound and the rally that we got today and we've been getting for the last few weeks. This week so far, it appears that we have a mechanical reason. For example, in the morning, in the last couple of days, we got gap downs and immediately, right away, the flow of money, the dip buying happened right away in an automatic fashion, in an algorithmic fashion. And today we get a gap higher even before trading starts. That tells me we have institutional flows. But there is a dangerous assumption behind these flows. And this assumption is the Fed has pivoted. The Fed is bluffing about increasing interest rates further. Matter of fact, the Fed will actually cut rates. This is absolute delusion. I'm going to expose to you why in details in this program. And without further ado, here it is, in focus tonight. Delusion. And it's not just by market participants, by the way. It's also by the Fed itself. Delusion all over the place, which means a rude awakening about to happen. We talk about the wall of worry in this program, and one of the items in the wall of worry is the Fed. So let's fly to DC and visit the Federal Reserve. Now, the Fed has been tightening the monetary policy by increasing interest rates. Some would argue aggressively. I would argue not aggressive enough. And I say that because last time we had this kind of inflation, the Fed chairman at the time, legendary Paul Volcker, increased interest rates above the CPI to kill inflation. Regardless of that, is the Fed policy right now in tightening the monetary policy working or not? Well, as I've showed you before, Dr. Friedman settled that long time ago. He said there is no inflation that did not respond to monetary tightening. Not a single case. So are we surprised that inflation is cooling down, at least from a commodities perspective, when the Fed is tightening? Not at all. But the Fed is not through with the job. And if they pivot right now, it will become another disaster, such as the 1970s and a déjà vu to Fed chairman at the time, Arthur Burns. One would argue the worst Fed chairman ever, second to Jerome Powell, of course. But we have evidence right now that the pivot crowd, this is what we're going to call them from now on, the pivot crowd, say we have evidence that the Fed policy is working, and there is no need for any more tightening or aggressive interest rate hikes. For example, they bring up the fact that we're seeing job openings moving down. Job openings went down by more than 600,000 in June. The pivot crowd would say, look at that. The Fed policy is already working. The tightening is already working. Why be too aggressive at this point on? We believe the Fed will actually pivot and start cutting interest rates soon enough. And therefore, we have to get ahead of the event and buy the stock market right now. Another piece of evidence that the pivot crowd brings up is that the economy is weakening. They don't admit that the economy is in a recession in certain corners. They're not going to go that far, but they admit that the economy is weakening. And they admit that because to them, the pivot crowd, and frankly to the market, but there's a misunderstanding with the pivot crowd. Bad news, bad economic news that is, means good news for the stock market. Because if we're seeing bad news in the economy, softening in the employment picture, softening in the rise of inflation, wage inflation going down, all of these, according to the pivot crowd, are good signs that the Fed policy is working we will indeed have the soft landing. But there is a limit to that. Too much bad news, well, guess what? Will turn out to be bad news for the stock market too. Because if we see massive layoffs, massive deterioration of the economy, then the pivot crowd will be exposed that it is not a soft landing and instead it is a recession. And the stock market is not going to do pretty good in a recession. But for now, they believe we have a soft landing because we're not seeing aggressive deterioration in the economy. We're seeing the soft landing. For example, the metaverse job postings are down 81%. So we're not seeing actual unemployment in the economy, but we're seeing job listings going down. And the pivot crowd says, you see, the fluff is coming out of the economy and the Fed doesn't have to do anymore. Robinhood came out yesterday and announced laying off over 20% of its employees. Again, the pivot crowd would say, look, Robinhood, a small company, part of the speculative side of the economy. So when we see unemployment rising higher, we want to see it in Robinhood, but not in Walmart or Ford, for example. Likewise, the pivot crowd would say, we're also seeing weakening in the demand in the economy. Today we heard from shipping firm Maersk, how you pronounce that. I can never get it right. But the company said that they're seeing weakening demand in the economy. Not only that, but warehouses are also filling up. So we're seeing demand all of a sudden disappearing from the economy. And hence the pivot crowd would say, look, inflation is going down. The Fed is done with the job. We're all going to live happily ever after. Because no real damage happened to the economy yet when it comes to unemployment. Of course, they're in for a surprise, but hold your horses on that one. Another piece of evidence that the pivot crowd will bring up is AMD's earnings, which confirmed Intel's earnings that we're seeing weakness in the PC market. So here we go, we're seeing weakening in demand. Nobody's buying PCs anymore. Maverick, why do you want the Fed to be more aggressive? The job is done here. The economy is weakening, but not by much. There is a soft landing for you. Matter of fact, the market was delusional to begin with. The market did not even believe the Fed's dot plots. As you can see in orange, this is the Fed rate hike expectations prior to last week's meeting with Jerome Powell, the conference. The dotted white line is the Fed dot plots. And even before Jerome Powell spoke, before he allegedly pivoted, the market was saying that the Fed will not increase interest rates as much as they told us before. In other words, the Fed is bluffing. And then after Jerome Powell spoke and the market believed that he pivoted, look at what happened in the line in blue. The line in blue is Fed rate hike expectations after Jerome Powell's conference or whatever that was. Now, market expectations say that the Fed will actually cut interest rates. So whatever the Fed says, who cares? The market says they're bluffing and therefore buy stocks now because sooner or later the Fed will actually cut interest rates, not increase them higher. Jerome Powell is done with the vacuuming, the QT vacuuming. Vacuum man, he's done. He took the liquidity and the inflation out of the picture and done. We're finished here. We're all going to live happily ever after, soft landing. And guess what? That plane doesn't serve peanuts only. We got adult beverages, full service, baby. No problems here. Here's the counter to the pivot crowd. Number one, after Jerome Powell's conference, inflation expectations actually went higher, significantly so. That's number one. Another one is the fact that the employment cost index is actually surging higher. It remains very elevated, which means that employers are paying more, and that means more wage inflation. And it's not just me saying that. Even Jason Furman, remember Transitory Furman, the propagandist that he is? Russia is just a gas station, the biggest misinformer in economic history. He also says that higher prices will lead to higher wages, which will fuel higher prices. It is a vicious cycle that will not end without aggressive rate hikes by the Fed. Even Jason Furman is saying that. And if you think inflation is over, well, what about the multi-billion-dollar bill that the Democrats, the Mansion Cave, are about to pass? Matter of fact, the Treasury Department says that they need an additional $262 billion in borrowing to pay for all of these bills. Billions and billions and billions of dollars all over the place. And they call it the Inflation Reduction Act. Oh, really? Likewise, the insane rally in the stock market that we got so far in the month of July, and it appears that we're building on last month's rally, that gives the Fed the room to increase interest rates even higher. We talked about Jerome Powell with the whack-a-mole. Every time the stock market goes higher, it gives the Fed the permission to increase interest rates even higher. We used to talk about the Fed's put, but the Fed's put is no longer. We have the Fed ceiling now. Every time the stock market rallies higher, the Fed will come out and say, okay, we got the room to increase interest rates even higher. On top of that, inflation is not really moving down significantly. One would argue that inflation is actually sticking and it might crawl its way back higher again. Look at cars prices, for example. The average right now sits at around $48,000 for a new car. Absolute insanity. The average car price used to be, what, $30,000, $35,000? Now we're talking $48,000, and that's the average. Most people's incomes are, what, $60,000, $70,000? So buying a car right now is more like buying a mortgage. And on top of that, the PCE inflation came out with a reading of 6.8% in June, indicating that inflation is not peaking. So if you look at commodities and say, oh, but inflation is peaking, Mr. Maverick, you don't understand what you're talking about. Actually, I do. My prediction is you might see the headline reading going down because food and gas, energy inflation is going down. But core inflation might stick and even move higher. A rare but really interesting phenomenon. The Fed kept saying, forget about headline inflation. We don't care about that because food and energy is too volatile. So we're going to look at core inflation, as if food and energy are not really that important to consumers. How about we take out oxygen too? But okay, Fed, you want to play that game? No problem. Now when the headline reading goes down, but the core CPI sticks or even move higher, are you going to say, oh, but we're going to look at the headline from this point on? Because all of a sudden, food and gas inflation is actually important. And I'm not the only one who think that. Even Mohammed Al-Arian agrees with me. Take a look.
So first, I think the consensus is headline inflation is going to come down, and I agree with that. But core inflation is a different issue. I think we will find that core inflation is going to be much stickier than what we see on the headline inflation.
And Al-Arian says that the Fed should not be distracted by calls that the economy is in a recession already and the Fed has to take their foot off the, not the accelerator, I guess the brakes, because the economy is weakening. Maybe the Fed is overdoing interest rate hikes. Al-Arian says if you do that, it will be a big mistake. Keep your eye on the prize. Take inflation down. And that means more interest rate hikes, not less. So the market is being delusional here, assuming that the Fed will pivot. Now let's hear some Fed zombies and what they say about all of this. We got zombie from Cleveland, Mr., and she says that the Fed has more work to do, meaning more interest rate hikes, because inflation has not peaked. She needs to see more evidence that inflation is peaking. All of a sudden, Mr. is a hawk. I wonder why. And you got another delusional madwoman, Daly from San Francisco, who used to say that inflation is transitory. But now she says that 50 basis points rate hike in the next meeting, in September meeting, is actually reasonable, quote unquote. And she also said that the Federal Reserve is nowhere near being almost done and finding the hottest inflation in 4 decades. Wow, where was this Daily last year? But she continues to be delusional by saying that I don't feel the pain of inflation anymore. Of course, because you're a millionaire. Then we have Zombie from Chicago, Evans, who remains a dove, at least for now, and he said that he is hopeful that the Fed can dial down the magnitude of rate increases over the remainder of the year. So he's being on the dovish side. And then we have our favorite, San Luis Fed President James Bullard. And a warning for new viewers of this channel, Mr. Bullard has the habit of smoking certain substances, and then he issues blunt statements, such as in 2020 when he said that by Christmas, the economy will recover completely, entirely, such as when he said that inflation is transitory. And now he says there is no recession. We're not going to have a recession at all. He also says that he favors front loading, go big, or go home. At the end of the year, the Fed funds rate should be at around 3.75 to 4%.
And now we've raised up a fair amount, but we've still got some ways to go here to get to restrictive monetary policy. I've argued that now with the hotter inflation numbers in the spring, we should get to 3.75 to 4% this year. And exactly whether you want to do that at a particular meeting or some other meeting, I think is a great question. I've liked front loading. I think it enhances our inflation-fighting credentials, keeps inflation expectations under control.
So Bullard wants to go big, but isn't going big will cause a recession? The front loading, as he says? Well, not according to Bullard. Bullard says We can increase interest rates higher and not get a recession. I can eat cheeseburgers every single day and not get fat.
Yeah, as the chair said, we're not in recession right now. We do have these 2 quarters of negative GDP growth. To some extent, a recession is in the eye of the beholder. There is an official dating committee, which isn't really official, the NBR dating committee. And that's really Bob Hall, professor at Stanford, so he makes the call. But with all the job growth in the first half of the year, it's hard to say that there was a recession. With a flat unemployment rate at 3.6%, it's hard to say there's a recession.
And then when he's reminded of his transitory call, he laughed about it.
75, not usually done. Usually it's a quarter, and you'd probably like to get back to a quarter at this point. But not only you, but Mester and others have said it seems like inflation might be a little more persistent, a little worse than we thought, and we may need to do another biggie, and then before you get back to maybe quarter points. Why should we not think that you guys missed transitory, basically? You said transitory, and now you're overshooting the other way. Commodities are rolling over. There's all kinds of things.
Are you saying you don't trust our forecasting model?
Yeah, that was funny. We got it wrong. Millions of people are suffering. Whoops. And then we have Governor Waller, who said that we can have a soft landing. Look, we're raising rates and the economy is holding. We're not seeing unemployment rising higher. And he got absolutely shredded to pieces by Larry Summers. We'll talk about Summers in a minute, but he was the most delusional Fed member in history. Neel Kashkari, the demon from Minneapolis, he came out today and said that inflation could still be transitory. Yep. For Kashkari and Waller, all the delusional zombies, and the pivot crowd, when you say that increasing interest rates is done for now, you have absolutely no idea what you're talking about. If the Fed pivots right now, we will see the same problem in the 1970s. Inflation will come back in a more aggressive fashion. Now, if you say that, look, Maverick, the Fed can increase interest rates without causing a lot of damage to the economy, no recession, because so far we're not seeing unemployment rising higher, significantly so. So the soft landing is a possibility. Number one, there is a lagging effect, meaning if the Fed raises interest rates right now, today, we will see the impact months from now. So you haven't seen anything yet. And the Fed needs to go even more aggressive to tackle wage inflation and the vicious cycle that continues to feed inflation higher. What does that mean? You say that we're not seeing damage in the economy so far, even after what? Multiple rate hikes? Because unemployment is not moving higher. But you're forgetting about the lagging impact. You're taking comfort right now because you haven't seen the worst of interest rate hikes. Matter of fact, even New York Fed Dudley used to be a Fed president, not anymore, so he can speak the truth now. He came out and said that the Fed will increase interest rates much further than what the market expects. It's not only him, by the way. When we talk about the neutral rate, this is what the pivot crowd talks about. We're already at the neutral rate, so the Fed doesn't have to increase interest rates anymore. Have you forgotten that the neutral rate is not at 2.5%? It's actually more than 5%. Here he is, once again, Mohamed El-Arian. Take a listen.
Why is it that you believe you're going to get the pivot? And if it's the second reason, you've got to be clear in your mind that we are neutral. My own instinct, John, as you know, is that the zip code for neutral is above where we are now.
How much further above?
At least 0.5 percentage points. And as everybody acknowledges, they're going to have to, including Chair Powell, they're going to have to go beyond neutral. So I think the market is looking for a pivot at a time when the only reason you would get it if the economy completely collapses.
And it's not just El-Arian who's saying this. Listen to Larry Summers, who absolutely wrecked Jerome Powell and his delusion when he said in the last meeting, the last conference, that the Fed is already at the neutral rate, 2.5%. And maybe this is why the market took it as the Fed is done. Listen to how Larry Summers absolutely crushes the delusion of Jerome Powell.
We also heard about where we were with a neutral rate on interest rates from Jay Powell. What do you economists do when you put together these neutral rates?
Look, I think Jay Powell said things that, to be blunt, were analytically indefensible. He claimed twice in his press conference that the Fed was now at the neutral interest rate, calling it 2.5. It's elementary that the level of the neutral interest rate depends upon the inflation rate. We've got on the most quoted measure a 9.1% inflation measure. if you extrapolate it off core or something, it's 4 or 5% inflation. There is no conceivable way that a 2.5% interest rate in an economy inflating like this is anywhere near neutral. And if you think it is neutral, you are misjudging the posture of policy in a fundamental way. So I was very sorry to hear him say that, and frankly surprised. He said back in 2018 that the neutral interest rate, that the Fed was approaching the neutral interest rate at a time when the inflation rate was 1.9%. How he could be saying the same thing today when the inflation rate is where it is inexplicable.
And Larry did not stop here. When you say that we're not seeing unemployment rising higher, and therefore we can have a soft landing, how do you suppose that the excess demand in the economy will be taken care of so inflation can go down to the Fed's target of 2%? You think magically people will stop spending in the economy anymore without losing their jobs? Without seeing significant rise in unemployment in the economy? Think again. Here's Larry Summers.
The danger, David, is that they don't persevere strongly enough in restrictive policy. And that's what gets you a stagflation situation where growth slows and you don't beat the inflation out of the system. It's like if you don't complete your course of antibiotics and then your illness comes back and the drugs are bacteria resistant. On the other hand, I don't think we can deny that if they do what's necessary to contain inflation, then it's not going to be a happy economic situation over some interval. My own research with Olivier Blanchard, looking carefully at vacancy statistics, looking carefully at quit statistics, would suggest that just to get to a neutral posture with respect to inflation, we're going to have to take unemployment up towards 5. And in order to bring down inflation, we're going to have to be restrictive, which means an unemployment rate above 5.
And here's my favorite piece when he took down delusional penguin Janet Yellen.
Secretary Yellen said yesterday that she held out the prospect of getting out of this without unemployment going above 5. I've got enormous respect for her as an economist, but I have to say that statement greatly surprised me. It didn't surprise me as much as the Fed saying we were going to get out of this with 4.1% unemployment, but I don't see any basis for thinking that either of those statements is a reasonable prediction.
Of course, Larry Summers is delusional himself, so we're not going to give him a lot of credit here because he came out and said about the so-called Inflation Reduction Act. Wow. Larry Summers said about that lousy deal, great budget deal announced today. This will mean progress on inflation, economic growth, tax fairness, inequality, and climate change. Does that mean the bill will increase inequality? Is that what he's saying? I don't know. Because the Inflation Reduction Act will actually increase your taxes. Yep, read the fine print. Anybody who makes over $75,000 will see their taxes moving higher. Who do you think going to pay for all of this lunacy? It ain't going to be the corporations. It's going to be you and me, baby. We're going to pay for all of that stupidity. And today, Goldman Sachs came out and warned the pivot crowd who are buying stocks right now, stampeding, because this is a generational buying opportunity. Goldman Sachs said investors may be getting overconfident in betting the Fed may cut interest rates sooner to bolster a flagging U.S. economy, according to Goldman Sachs strategists. You know why? Because if the Fed actually stops increasing interest rates or even pivots to cutting interest rates, it will be for the wrong reasons. It will be because the economy is weakening faster and more aggressively than we ever thought before. They will cut interest rates because the economy is in a massive recession. You think stocks will do good when the Fed cuts interest rates because we have a recession? This is absolute delusion. If you're buying stocks right now thinking that the Fed will cut interest rates, we will live happily ever after, you're in for a massive, massive surprise. And it ain't going to be a pleasant one. Now, with that, folks, let's move on to cover the stock market for you. We start with the closing of the indices. And here we go. The Dow Industrial Average up by 416.33 points, or a gain of 1.29%. The Nasdaq up big by 319.40 points, or a gain of 2.59%. The S&P 500 also in the green, scoring 63.98 points, or a gain of 1.56%. The sector's performances were led by number 1, capturing the gold medal, communication services, number 2 for the silver, consumer cyclicals, number 3 for the bronze, technology. And the notable laggard of the day is energy. Energy is down because crude futures were down. We're going to talk about that in a minute. But here's the advance to decline ratios. NYSE 64% advancing versus 30% declining. The Nasdaq 70% declining. Excuse me, that would be crazy. 70% advancing versus 25% declining. Moving on to futures, commodities, what's going on here? Down across the board for the most part, but energy commodities were down big. The WTI down almost 4% for the day, Brent down over 3.5%. RBOB, gasoline, is down by over 4.5% for the day. Yet heating oil scored some modest gains. And here is again the party boy, natural gas, the winner for the day, scoring gains of over 7.5%. I had a trade yesterday for the UNG. You could have actually got into the trade in the morning today and scored big. And we're talking big, like steak and lobster kind of trade. But why were crude futures down for the day? The answer is because we got some production increases from OPEC+. OPEC+ approves tiny oil output in a rebuff to Biden. Wow. So they're saying, Mr. Biden, here's one for you. But why did the market react so negatively to that? Before we answer that question, let's read some of this article. OPEC+ is set to raise its oil output goal by 100,000 barrels per day, an amount analysts say was an insult to U.S. President Joe Biden after his trip to Saudi Arabia to ask the producer group's leader to pump more to help the United States and the global economy. In other words, the begging tour. But here it is. Listen to this. The increase equivalent to 86 seconds of daily global oil demand. Wow. But the market reacted so negatively to this because the market believes that we already have headwinds for crude oil. And the top headwind is the upcoming recession. So now OPEC+ are increasing the production when we see a recession in the horizon. Doesn't make sense. And therefore the negative reaction in the futures today. What about softs? Lumber continues to collapse, losing over 7% today. Likewise, cocoa futures down almost 3%. Cotton also declining by about 0.75%. On the other hand, we have winners today, led by OJ futures, which moved higher by over 3.25%. And then coffee also scoring gains of a little over 2.5%, and sugar futures with modest gains a little over 0.5 percentage point. What about metals? Down across the board. The dollar went higher initially, then it went down, and since settled at the neutral line, flat, no action at all. So metals closed based upon the initial reaction, which should be the actual reaction. Maybe we'll see confirmation of that tomorrow. But gold was down, silver down, platinum down, copper down, palladium down big, losing about 4% today. On the other hand, meats, we have muted negative action for lean hogs, but modest positive gains for feeder cattle futures of about 0.75%. Yet the winner of the day is live cattle futures, with gains of almost 1.25%. And lastly, grains down across the board. Soybeans, corn, wheat, oats, canola, all down, with the exception of rough rice futures, which closed in the green with gains of a little over 1.5%. Moving on to the big casino, the options market. What's going on here? The volume is moving higher slightly, and we're seeing buying of calls revving up once again, in certain names at least. But regardless, at number 1, the hottest table by far was Apple at around 1.4 million contracts traded today. About 55% of those were calls. At number 2, Tesla with around 1.2 million contracts traded today. About 65.5% of those were calls. And Amazon, number 3, at around 1.2 million contracts traded today. About 55.5% of those were calls. Moving on to the unusual activities that took place in the options market today. We start with the ticker ARKKKK for Tesla, which cut the wood. It has been a great run for RKK as of late because the pivot crowd, the Fed is not going to do anymore, so you buy the trashiest stocks, and there is no bigger dump than RKKKK. But somebody's fading the rip, and I did follow this trade today. They bought the 45 puts for the expiration date October 21st with expectations that the RKK will move down and lose more than 9.5% of its value by then. They paid around $3 a piece to enter this trade, all in all, spending around $6 million. And then we have the ticker ZS for Zscaler. Somebody is also fading the rip here by buying the 150 puts for the expiration date, August 19th, with the expectations that ZS will move down by then and lose about more than 9% of its value. They paid around $3.50 a piece to enter this trade, all in all, spending around $4.5 million. What about the ticker CFLT for Confluent? Somebody is perhaps about to eat a massive pie in the face, but we'll never know because the name reported earnings after the bell, and last time I checked, it is ripping higher. But we've seen instances where the stock rips higher after hours after reporting earnings, and then it flushes down the very next morning. So this could be the case. For the ticker CFLT, at least according to one trader, who bought the 22.5 puts for the expiration date, October 21st, with expectations that the name would lose over 22.5% of its value by then. They paid around $2 a piece to enter this trade, all in all, spending around $2 million. And lastly, what about the trade for the ticker GJWN? And this is for Nordstrom. Somebody's buying puts in the name, the $20 puts for the expiration date, September 16th, with expectations that the name could move down and lose more than 20% of its value by then. They paid around 75 cents a piece to enter this trade, all in all, spending around $750,000. Moving on to the heat map analysis, what's going on here? Mostly green across the board with very few exceptions, mostly in energy. Crude futures are down, so oil and gas stocks are down too. Some weakness in materials, some weakness in the big pharma names, the names that reported earnings today. We have weakness in Walmart, WMT, in defensives. That's because Walmart is laying off employees. Surprise, surprise. And we have weakness in technology in AMD, not by much, but AMD was down after reporting earnings. But besides that, green across the board, led by the big caps. The big caps did the heavy lifting: Apple, Microsoft, Google, Meta, Amazon, Tesla. What does that say? We're seeing programmed inflows into the market. The institutionals, retail, doesn't matter. And they're buying the ETFs. They're buying the Qs. They're buying the technology ETFs led by the big caps. What happens after the programmed inflows are done? Are we going to see a follow-up by the retail crowd? Are we going to see a follow-up by the institutionals? Because if not, this is going to be just another bull trap, another bear market rally. But the key is inconsistency. What does that mean? Where are the fundamentals? The answer is they're actually in utilities, the most hated sector of the stock market, because it is the most boring, but the fundamentals are good. Take a look.
I guess the positive news is that about 74% of the companies so far that have reported are actually reporting a beat here on the bottom line, and maybe more better forward-looking guidance. About 34% of those companies are also guiding higher in terms of the bottom line as well, though about 30% guiding lower. Again, though, the big question here is how much had we really cut some of these estimates coming into this earnings season? What goes for the year goes for the earnings season. Energy, utilities, of course, the best performers on a price basis on the S&P 500, and also sort of the best performance in terms of actually the top line surprise here. Maybe showing some of the pricing power and whatnot, at least when we think about some of the inflationary environments underway and the top line translation of that.
So at the end of the day, we might see some weakness in the XLU and utilities, but it will be the last man standing when the shitstorm hits. Now let's move on to corporate news. We have Toyota for you. TM, the ticker, was down today. And the reason is we got news that Toyota has been falsifying emissions data from at least 2003. Wow. No wonder why Toyota's cars are more reliable. They got that old school polluting engines and emissions. If you feel that you're down and you're done with life, you lost it all, you know what? I'm not going to do that joke. It's kind of dark. But anyways, Let's move on to the next piece of news. On Friday, we're about to hear Elon Musk's response to Twitter. And apparently Twitter is making Elon's life a lot harder because they're now subpoenaing a lot of his colleagues, friends, associates. Among them, of course, the SPAC con man, the SPAC Jesus, Shamath blah 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 blah. Am I feeling bad for them? Of course not. Let's move on to the heat map for the ETFs. What's going on here? Green across the board, but the notable weakness is energy ETFs, XOP, XLE, all down for the day. OIH, even TAN for solar down for the day. If you have inverse indices or VIX proxies, you got hit hard today. But when we talk about commodities, look at the UNG for natural gas. That ripped higher significantly today. You could have scored gains buying call options on UNG, or even better, the ticker BOIL, massive gains for the day. When we talk about the contrast between growth and value, both in the green, both scoring gains, yet growth is outperforming value. And this has been the theme, by the way, since the June bottom. Whether that's going to last or not, who knows? Probably not. But for now, enjoy it while it lasts. Now, let's move on to charts, and we start with SPY, the S&P 500, 30 minutes chart. What's going on here? The double top was a bear trap, and hence the pies that we got today, at least some of us. What do you know? In the morning, the futures rip higher, we see a gap higher, and the chart makes it all the way, not only capturing 410 as support once again, but moving all the way to the next resistance at around 416. Why do I feel that this is a bull trap this time around? They gave the bears a bunch of pies in the face today. I have a feeling they're going to give the bulls a bunch of pies tomorrow, or at least by the end of the week. The RSI remains elevated. It got actually more elevated. It appears that 416 is stiff resistance for now, but if the flows continue in the morning, who's to say we're not going to see another gap higher tomorrow? At some point, it's going to get really, really overextended. And the sellers will put two and two together and say, you know what? They've overdone it. They're being overconfident. We know the Fed is not going to pivot, not anytime soon. This is an opportunity to short. Perhaps book profits or even losses at a better price. And this will keep a ceiling on the market continuing to move higher in this rebound rally. If the chart moves down, we have the support of 410, and then we'll take it one step at a time. What about the daily chart for the continuous contract for the SPY, the S&P 500? We're now officially in the danger zone. It's not danger meaning we have to flush down, but it is dangerous because it is a stiff resistance kind of zone. Let's say the support is 4100, the resistance at around 4300. I don't see the market blasting above this zone easily. I see it either number one, the bullish scenario, it consolidates for a little while before finding the energy to make another leg higher past the consolidation zone. Or scenario number two, the bearish scenario, the chart's going to consolidate for a little while and then the chart runs out of gas, runs out of steam, and the buyers who bought in June, July, they start to put two and two together and book profits and the chart starts to lose ground. But we're not going to become really bearish in the chart unless it starts to lose momentum, meaning losing important support lines. In this case, it is 3,960. But even if that's lost, is the chart going to form a lower low or a higher low? So the bears have a long way to go here before they become emboldened once again. What about the Qs? 30 minutes chart, what's going on here? The chart did not give a rat's ass about the double top at all. The technicals did not matter at all today. Massive inflows in the morning. And that's what really matters. The problem is, why do I have the feeling that they're going to serve pies in the face of those who chased the rally today? I say that because we have the RSI, the MACD indicators getting really overextended. We've seen the chart pulling back from these readings before. Number one. Number two, the higher these charts go in an impulsive fashion, the higher Fed rate expectations will go, and hence the ceiling on any rally in the stock market right now. If we go down, we have the support of 316.5, but if the chart moves higher again, guess what? I don't see any significant resistance from this point on. Next resistance is way up at around the 335 levels. So in theory, we have the recipe for an enormous summer rally. But we got to take pauses. We got to take pullbacks. It cannot be this impulsive in one shot with the NASDAQ scoring 2-3% worth of gains in a single day, which is, by the way, another characteristic of a bear market rally. Here's the daily chart for the continuous contract for the NASDAQ. So far, so good. The support remains 12,766. The resistance at around 13,300. The volume picked up higher by a little bit, but it remains at around average. And then we have the momentum indicators Still positive, firming up, but they're about to get overextended. Doesn't mean that the chart has to pull down now, but we're getting close. And here's the NASDAQ NDX, the weekly chart for the big NASDAQ 100. I'm showing you this because we have a curved line of resistance with lower highs that has been broken, and hence the pivot, if you want to call it that, in this chart, from bearish momentum to bullish momentum. Now, the chart did pass an important resistance, now support, at around 13,065, but we have another, perhaps stiffer resistance at around 13,556. So we need a pullback. The bulls need a pullback, because if this continues in an impulsive fashion, the next step will be an impulsive, massive flush down. The higher they go, the bigger the flush down, the bigger the pullback. Next, what about the IWM, the Russell 2000 30 minutes chart? The bear flag did not work out. The technicals from yesterday did not matter at all. The chart is now above the support. Used to be resistance at around 188. The next resistance at around 191. But again, I have a hunch that we're going to pull back. From a technical perspective alone, the reason would be the dollar moving higher. Today, the dollar moved higher in the morning, but then it pulled back and closed pretty much in the flat line. But if the dollar pops higher again, it gets really hard to see this rally moving any further from this point on. Here it is, the Dixie, the dollar index, daily chart. What's going on here? We have what do you call a doji candle, meaning indecision. It went up, it went down, and it closed pretty much in the flat line. My hunch is the dollar is going to pop higher because the momentum, the bearish momentum, if we look at the RSI and the MACD indicators, the bearish momentum is peaking. You see those columns in the MACD getting shorter and shorter and shorter. The next step will be for the dollar to pop higher and move into positive/bullish momentum for stocks. Speaking of gold, here it is consolidating in a positive pattern, a bull flag pattern. It has positive momentum for now, but if the dollar moves higher again, it's hard to see gold moving higher, along hand in hand with the dollar. So this resistance that we have right now in gold at around 1,763 will prove to be tough unless the US dollar decides to go down. What about Brent oil? 4 hours chart, what's going on here? It could not even keep the support of 99. Now we have the last support at around 94.47. If that support is broken, it's over for oil. It's gone. It's not going to be above 100 anytime soon. So it is critical for oil bulls to close the week above 100. I'm not going to be picky. I'm going to say 99, but it got to be a weekly closing above 99. Next, we have the 10-year yield. What's going on here? It hit the resistance at around 2.72 and could not make it above that number. Doesn't mean that the pop is over in the 10-year yield. Matter of fact, I believe that this bearish pattern in the candlestick will prove to be another pie in the face for those betting against the 10-year moving higher. We'll see what happens. But for now, here's the TLT. The TLT, better candle for the week than yesterday's look. Can it make it all the way to close the gap at 125.12? It's going to happen someday. Is it going to happen in this leg or another one? The bond bugs are hoping for this leg to get us all the way at 125.12 and perhaps a lot more. But it all going to depend on what the Fed rate hikes expectations are going to be. The Fed is telling the market, don't buy bonds. Don't buy the TLT because we're going to crush your head. We're going to increase interest rates higher. But the stock and now the bond market is saying, Fed, you're bluffing. But the bond market is being more mature than the stock market. The stock market says, the Fed, you're bluffing. You're actually going to cut interest rates. We're going to have a soft landing, and everybody's going to live happily ever after. The bond market says, no, Fed, you're bluffing. You're going to cut interest rates at some point near the future because we're going to have a recession. And therefore, we should rush to the safety of bonds and buy the TLT and otherwise. This is the difference between stocks and bonds. Bonds, a more mature approach. Stocks remain immature. Moving on to the VIX, what's going on here? Yesterday, we talked about an ABC pattern that could take us above 24.29. This is a 4 hours chart. The ABC pattern did not work out. Matter of fact, we have a crossing in the MACD indicator. We don't have a confirmation yet, but it is showing negative momentum for the VIX. If that continues, it means that we have support number 1, the gap, at around 21.53. Support number 2 is 20. And if we get to 20, I will be buying puts with both hands because they will be cheap. Number 1, I can hedge my portfolio buying puts at a cheaper price. Number 2, I can bet against the speculation and the weakest names that are moving higher right now, and these puts will be a lot cheaper when the VIX is reading at 20 versus at where it is right now. But again, why do I feel that we have a trap coming? meaning the VIX pops higher again, the SPY moves down, Qs move down, at least in a pullback. I'm feeling it, but I cannot pinpoint it. Let me know if you think the same thing in the comments. Here's the VXN. Any problem here? Any development at all? Not really. The chart is still keeping the important support of 27.5, and if we clean up the chart and use different indicators, the Nasdaq bears would argue that what we're seeing right now is a resistance pattern of lower highs that has been broken. And the VXN is forming a bull flag pattern, which means the volatility for the Nasdaq is about to pop higher. In other words, Qs will go down. Moving on to Apple, a daily chart. What's going on here? Yesterday, it looked pretty good to buy puts, bidding that the gap will be closed at 157. Yours truly did the same thing by buying puts, and what do you know today? I got a massive pie in the face, a massive pop in Apple, worth about 4%. And of course, Apple is going to pop by 4% right after I bought puts. So if you happen to hold Apple calls, you have me to thank for your gains today. There you go. But here's the thing. I believe that I was a little too early, but not wrong. Does that mean that the trade is still on? Not really. I closed it in the morning, but I placed the trade once again by the end of the day, right before the closing. But I went with a longer expiration date for September, and I upped my strike from 155 to 160. Now the chart, looking at the RSI, has room to continue to move higher, and it can go all the way to the next resistance at around 170, 172. But the risk versus reward says by September, that gap below should be closed. But this time around, I entered using batches. So I bought batch number 1 today. If the chart moves higher tomorrow, I'll leave it as it is. If I see a sign of a reversal from a resistance line, or even not a resistance line, doesn't matter, just a candlestick reversal pattern, I will add batch number 2. And then as the chart gets closer to 157, closer to 160, and we see more weakness, more bad news in the fundamentals, I'm going to add batch number 3. And that will complete the trade. Next, we have Tesla, 30 minutes chart. What's going on here? Yesterday, we got a break in the triangular consolidation pattern to the downside. Today, we got a gap higher and a break above the consolidation pattern to the upside. And then Tesla went back to the neutral line, closed the gap, consolidated, and moved slightly higher from that point on. There's nothing to see here. There's nothing we can read from the action that we got from the chart today. It is not overbought. It's not oversold. The assumption for now is, if we look at the daily chart, the positive momentum continues until we get a reversal signal. And a reversal signal will not happen without the chart losing important support lines. So we have 886, that is support line number 1, and then we have 866. The chart has to lose some of these support lines before the bears get excited once again. Now, if the chart continues to move higher, we have the resistance, the top of the previous candle. I believe this is a mistake. It's actually at around 935.5, not 936.17. So it is 935.5. That would be the resistance. And some would argue, looking at other charts, the hourly, the 2 hours chart, that Tesla's getting overextended. Meaning, if it gets all the way back to the resistance at around 935, that would be a permission to place a put options trade, betting that the name will have a pullback. Next, we have Bitcoin, tulips, 2 hours chart. What's going on here? We talked about the sloping line of resistance. It was broken today. It was one of the indicators I was watching, but it turns out to be a false break. So watch out here. If this is indeed a false break, that means Bitcoin will move down. If it does move down, it is an indicator for risk off, not risk on, which means the Nasdaq will lose ground. The RKKs of the world will also lose ground. We will see the safety trade in utilities, REITs, and consumer staples taking charge once again in the leadership of the market. And lastly, before moving on, somebody pointed out that in my charts video, I forgot to cover M, the ticker M for Macy's. So here it is. Here's what I said about the name last time I talked about it. What? I say short the name. At least I did short it today. When you look at the weekly chart, are we seeing a bear flag formation? The name closed well below the highs today, and I see a lot of trouble for this name. Now, it is too early to short, I'll give you that. But again, I shorted Peloton, Zoom, DocuSign, Mama Cathy Wood, RKK, Moderna, and everybody told me that, you're crazy, bro. You're gonna lose everything. The shorties will die. Turns out, these were some of my best trades ever. So I'm shorting via put options right now, and if the stock drops down, I might short for real. And here's the update. The bear flag played out, and we're now at an important Fibonacci support at around 17.25. If the chart breaks this support line, we will see more losses to come, and I would probably double down on the shorts. But I have a feeling that this line will hold, at least for now, because it held on before, multiple times. But I have yet to reach a conclusion here. I need to see another candle, a big pop that tells me that 17.25 is solid support. And the next step will be breaking the resistance at around 21. If that is the case, the next step will be closing the short trade, and perhaps you might want to go long here. I personally would not, because the company has a lousy balance sheet, lots of problems. With interest rates moving higher, a company like Macy's will not survive. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have, per usual, the initial jobless claims. We also have the trade deficit and more Fed zombies speaking. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.